SpaceX could literally be the company that changes humanity forever, right? We're talking about total domination of rockets, satellites, global internet infrastructure, basically the entire future space economy. But, and this is a massive but, there's another possibility staring us right in the face. What if investors today are paying for a future where absolutely every single thing goes perfectly? So the biggest question right now isn't really whether SpaceX is an amazing company. I mean, we know it is. The real question is, can an amazing company actually be a terrible investment at its current price?
Because following this historic launch on the public markets, we've got to step back. We have to separate the undeniable, mind-blowing technological triumphs from the hard, cold financial reality. Look, there's no doubt SpaceX is positioned to monopolize the orbital economy. But as a retail investor looking at this stock, you really have to ask yourself, are you buying into a once-in-a-generation opportunity, or are you just paying a massive premium for a flawless future that hasn't even happened yet?
Okay, let's dive into this. On one hand, you have the dream, right? The ultimate space infrastructure monopoly. But on the other hand, you have the reality of the numbers. We are talking about a massive $1.77 trillion IPO valuation. Trillion with a T. To understand whether that number makes any sense at all, we first have to break the illusion that investors are simply buying a rocket manufacturer.
Which brings us to part one. Inside the SpaceX machine. 3 businesses in one.
See, SpaceX operates way less like a traditional aerospace manufacturer just bending aluminum, and much more like a hybrid software utility. The financial architecture here is completely unique. Basically, you've got 3 different beasts under one roof: the original rocket launch business, a satellite telecommunications network, and now a highly aggressive artificial intelligence platform. And as you'll see, each of these has a drastically different financial profile.
To really understand this machine today, you've got to look at the projection. First up, the original space division, the rockets actually getting payloads into orbit. This brings in about $4.1 billion in revenue, but it actually operates at a loss. Why? Because of the massive development costs for the next generation Starship. Meanwhile, the connectivity division, Starlink, is the actual profit engine. We're talking $11.4 billion in revenue and an incredible $4.4 billion in operating profit. That's huge. But then we have the third pillar, the newly integrated AI division, xAI. And right now, that is a massive multi-billion-dollar cash drain. So you've got 2 segments making money today and one that absolutely does not.
Moving on to part 2, the bull case, the trillion-dollar moat. Let's look at why Wall Street is so hyped.
And this brilliantly illustrates exactly what investors are salivating over: Starlink's explosive growth. By the first quarter of 2026, they reached 10.3 million subscribers. And what's really incredible here is that Starlink operates on a subscription-based utility model. That gives it a SaaS-like 63% EBITDA margin. They are essentially acting as a global internet service provider, except they own their own infrastructure in space. For an investor, that means highly predictable, high-margin, recurring cash flow.
But wait, it's not just consumer internet. SpaceX is incredibly deeply entrenched with the US government and military. I mean, they recently secured a staggering $2.29 billion Space Force contract just to build the Space Data Network backbone. That's part of the Golden Dome Missile Defense Initiative, utilizing Starshield, which is basically the government-focused encrypted VIP variant of Starlink, adding classified payloads for the National Reconnaissance Office and their role in the Commercial Augmentation Space Reserve. And what do you have? A recurring multi-billion-dollar defense revenue stream that is practically bulletproof.
Now, underpinning all of this success is their structural cost advantage. By pioneering reusable rockets like the Falcon 9 and now developing the massive Starship, SpaceX has captured over 80% of the global market share for mass delivered to orbit. 80%. They've managed to drive down the launch cost per kilogram by over 95% compared to historical industry averages. Think about that. They are actually their own biggest customer, launching their own satellites for just a fraction of what it would cost a competitor. That vertical integration right there, that is the absolute foundation of their entire valuation.
All right, so that's the good news. Let's jump into part 3, the bear case, valuation gravity and AI cash burn. Because here's the thing, every rocket has to fight gravity. And in financial markets, gravity is valuation and cash burn. Look at this. Capital expenditures have absolutely exploded, going from just $4.4 billion in 2023 to a jaw-dropping $20.7 billion in 2025. So what drove this massive spike? AI. Following the acquisition of xAI, the cost to build orbital AI compute and massive terrestrial data centers just skyrocketed. The crazy part, the profits being generated by Starlink are actively being drained right now just to fund this new AI infrastructure race.
To put that into perspective, the S-1 filing reveals a staggering $14 billion burn rate required just for the XAI development war. That includes building out their massive Colossus data center. It's so expensive that SpaceX had to take out a $20 billion bridge loan just to fund this rapid expansion. So as an investor today, you really have to realize you aren't just funding space exploration anymore. You are heavily subsidizing Elon Musk's very expensive battle against OpenAI and Google.
And then we stumble into the governance trap. Through a dual-class share structure, Elon Musk holds about 40.5% of the company's equity post-IPO, but he retains a dictatorial 82.4% of the voting power. So what does that mean for you? Well, as a public investor, you're buying a slice of the cash flow, sure, but you are getting absolutely zero control. You have no say in whether the company focuses on getting to Mars, or if it pivots entirely to AI. You are betting the whole shebang on one man's execution.
Which naturally leads us to part 4. Valuation check. Does the math work?
The IPO priced SpaceX at a historic $1.77 trillion. That makes it the largest public offering in history. But independent financial research firm Morningstar, they pegged their fair value estimate at just $780 billion. Let that sink in. That means the market is asking everyday investors to pay more than double what some traditional valuation models suggest the business is actually fundamentally worth today.
So the crucial point here is summarized perfectly by this exact quote from Morningstar's analysis. They note that they are likely to view the shares as overvalued in almost any scenario, at least in the near term. At $1.77 trillion, the stock is mathematically priced for absolute perfection. It completely assumes Starship scales perfectly, those massive AI investments pay off big time, and no competitors ever catch up. There is literally zero margin of safety built into this current price tag.
Let's look at the actual metrics here. SpaceX debuted with a price-to-sales multiple of 94 times their 2025 revenue. 94 times. Traditional aerospace companies and direct competitors like Boeing, Lockheed Martin, or Blue Origin, who are fighting desperately to catch up, they trade at just 1 to 3 times sales. Heck, even massive, dominant tech monopolies like NVIDIA only trade at around 20 to 30 times sales. So you are paying an incredibly aggressive tech monopoly premium for a company that still operates in the highly capital-intensive business of physical hardware. You're effectively betting that competitors like Blue Origin or Rocket Lab will literally never crack their moat.
Okay, part 5, the synthesis, investor strategy. Let's talk about what you can actually do with all this information.
Your game plan here depends entirely on your time frame. For the short-term trader, that wild 19% day one jump actually makes sense because of what's called a float squeeze. Basically, only about 4% of the company's shares were offered to the public, which created this massive, intense demand against a tiny, tiny supply. But the huge risk there is that later this year, early investors will hit their lockup expirations. If they flood the market with shares, that could potentially crash the price. Now, for the long-term holder, your main catalyst is waiting for Starlink to hit those 75% operating margins and for Starship to fully commercialize. But you've got to have the stomach for that massive IA capital burn and any inevitable technical delays along the way.
Seriously, if you take only one thing away from this explainer, let it be this core philosophy. A great company does not automatically mean a great investment. It just doesn't. The price you pay matters just as much as the quality of the underlying business. Because buying the absolute best company in the world at the wrong price, well, that can still lose you a lot of money.
And finally, part 6, the final investor verdict.
Here's how we're breaking it down. Business quality, that gets a solid 9 out of 10. Their vertical integration and reusable rockets give them an unmatched moat. Growth opportunity? Honestly, a 10 out of 10. They are literally building the fundamental infrastructure for the entire future space economy. But current valuation, that has to be a 3 out of 10. At nearly $1.8 trillion, the stock is mathematically priced for perfection. That leaves virtually zero room for error, technical delays, or any sort of cash flow crunch.
Which leads us with one final, absolutely critical question to ponder before you even think about hitting that buy button. When you purchase this stock today, are you truly buying the railroad to space? Or are you just heavily subsidizing a $14 billion artificial intelligence war? Keep a very close eye on that upcoming earnings report, folks, because the answer is going to be written right there in the cash flow statement.